Good afternoon, everybody. Currently, New York open, and we have news, which, as you can see, is bearish news on USD. So we are getting our reactions as thought, uh, and let's have a look. So I did get an alert. Was it EU? Okay, there is the timestamp. It was only EU. 1.14151. 1.14145. Okay, so let's see how it react to this. So as you can see from the news, it is extremely bearish. Bearish. And that means that, excuse me, but let me see how bearish it is. So by 0.2%, 0.2%, 0.3%, but the overall drop by 0.9%. And yeah, it's very bad. Now look at DXY. So that means it would have dropped below that weekly fair value gap. No. Okay, it's still in the midst of it. We have some tomorrow as well. Okay. I don't think we're going to get that much of a pullback, but we'll have to see. I believe they use 101. I think there's no way they don't use 100 flat. There's no way they don't. I mean institutions. So let me see here. It doesn't actually look that clean. But I know for a fact they would use it. Obviously it's an index though, so it's not exactly a price level. So you can't say like, I think it's like a cumulative number. Okay, cool. Just seeing the impact, right? So that's essentially going to just shake up everything. So although it is going to shake up everything, we should be getting a sense of direction, I think. By that, I mean that because we've now had this bias or this push, we should be able to now see price declare where it wants to go rather than where it is at the moment. So we should now see clear direction. There's a lot of pairs I was unsure, but now we should get some clarity. So NZD CAD, we're gonna start from the top down. Okay, let's open everything. Right. So NZD CAD is our first active business. So on the weekly time frame, if you want to look at the line charts a little bit cleaner, we're kind of it's very messy. On the daily, it's a little bit cleaner. We did have a market structure breakdown here where we created this lower low. Preston came up, and continued up, breaking the swing high, as you can see here. So we traded above it initially, but I deemed that as a liquidity sweep, meaning that price is now going to continue its bearishness, at least to fill in this fair value gap here, and then potentially take out some swing low liquidity here and here. Instead, with this new unraveling, we can now see that price on NZD CAD is now bullish in the sense that it wants to go up. Well, rather that it's taken out the swing high over here, and we can now say that this has fully been filled, which is the daily fair value gap. Well, I mean, to be fair, it's been filled by this point. So we're going to have liquidity here. Liquidity here, and of course liquidity up here and here. Okay, so we've had that big push up. And you can see prices slowly come back down on DXY. You can see that prices reacting to this weekly fair value gap right here. Those wicks are kind of what I'll be seeing. And I expect price to come up and then continue its downward trend. I don't think that that manipulation was enough to change directions. This is old. I don't know what this is. Get rid of all this old stuff. I'm assuming that's green and red. So liquidity equal highs and the weekly fair value gap. I think that would be the target. So I'll be bullish up until the point where price takes this out right here. In terms of entries, we actually took this liquidity here and used that as fuel. This is actually the only liquidity sweep I can see, because London didn't take out Asia, New York didn't take out London. The only time we took liquidity was when we dipped below this swing low here, which was us dipping below this swing low here. So this swing high is the equivalent of this swing low in terms of the effect that should occur next. Okay. So we had this liquidity sweep, came back down to this low, pushed up, breaking this high, pushed back down to this order block, and then pushed up again, which was news, taking out this liquidity on the smaller time frames. And on the larger time frames, you can see there's a lot of clusters here. So we've taken out this area as well for liquidity. Bam. So these are now equal highs. Essentially, we're looking for price to continue, like I said, to the target, which is this weekly fair value gap, which you've yet to fill. And there's also got equal highs here, 1, 2 touches. And we also have this liquidity, 1, 2, 3, now near it. Now for us to enter, it would have to pull back to at least equilibrium. And that is, of course, all the way down here. Optimal trade entry, you can see there is a 1 bearish candle here and a series over here. Series, single. That's the body of the candle. We also still have news here, 3 p.m. And that might help because it is a where he's only done one. was a couple months ago. Let me find out about this guy a little bit. Let's see if his personality will lead to. I'll be investing in a proper webcam. I don't want to set up like a proper camera every time I stream, so I might look to get a decent webcam, which I should plan in by the end of the year, kind of a thing. So I lost my medication, which is sad. I doubt this guy will try to say anything bad. It's just dependent on the questions that he gets asked, and I'm not sure how much manipulation there is there. Nevertheless, with this news event, I generally like to have an idea before, like, of what price all the news will do beforehand. And you can sometimes read it in the price, but I had no clue for this session. So this is the low of the week. Shouldn't expect price to come below here if we're bullish, which it being Tuesday, New York Open. The best thing would be, if it's to happen this week, is for price to actually come down. Leave this liquidity alone, come down into one of these fair value gaps down here, and then take it out afterwards. It could also sweep to come down to then go back up again, but it should not come below here. Okay. This is now the new area. Price should come below here as well. It's kind of similar vibes with NZD USD. Would expect price, or not expect, but would wait for price to come below equilibrium, and then of course continuation. Indicator. So I'm trying to find day separator. We gotta start from here. Disgusting. There we go. This is quicker. Oh, this just been straight bullish. It's extremely bullish. We would have hit the target. I mean, next target would be all the way up here. Yeah, it looks like it potentially wants to come back down. Taking out the low. Retail be selling over here. It's actually not bad of a place to sell, because they would be using this as a heads and shoulders. Selling here would be nice because there's so much. The target is imbalance here and imbalance here. Yo. Okay. Also, I was meant to finish off the video I was watching yesterday before I streamed. That did not happen. Apologies. I also didn't do the homework I've set, but I am gonna have to have a shorter stream just because I'm busy. Like I said, I have to leave my house around 5, no, 6, and it's 2, so 4 hours. So, 5 hours study time. Not I can't see it. It's right there. So the last 40 minutes of this. But first, can we watch this? Okay.
All right, folks. So we're going to be looking at NASDAQ here. I did the PowerPoint perspective today because it helps me stay very focused. It helps me get through it succinctly and avoid all the potential rabbit trails I can go down. I don't have much time today, and I'm going to be doing this earlier than I was expecting to. My wife and I have things. So here's the daily chart, and we're going to focus in on that little area here. So everything I'm going to zoom in just shows the part that's shaded here in yellow.
This is interesting because I struggle when prices like shows this kind of choppiness.
And I want to take your attention into this discount wick and this up close candle. Okay, so these are two reference points that were not given to you yesterday when I gave you the post with lay of the land. Okay, buying in and of itself, the 15-minute time frame, I can find setups off of that. I can give criteria around that. It's a bellwether chart, meaning that it's a really strong go-to time frame, especially for intraday or short-term trading. It's basically one of those things you can utilize in and of itself to frame all day trading, all of your scalping, and get in sync with a move that's already underway on a higher time frame. So from a daily perspective, for the folks that say, I just can't use intraday charts, Michael, can you just give me some help in that regard? Well, that's what this is here, okay? So these are like the confirming strengths, okay, or the qualifiers that help yield more confidence behind the things I'm looking at, sub 1 hour, sub daily, anything intraday. If you look at the boundaries I created here with this, last up close candle, the open price. So that's changing the state delivery. That's happening here. So it's being utilized there. So it trades up into the order block. And the discount wick here frames the low end. So I've measured the closing price. The low of that candle and then the consequent encouragement level there. Okay. So consequent encouragement comes in at 29,221.75. Market trades down today, hits consequent encouragement, breaches the previous day's or previous week low on Thursday, rather, not the week of, but last Thursday's low because there was no trading on Friday. Not that would be meaningful, let's put it that way. So the run below this low and in this general vicinity was what I was framing. So when I was posting on X Monday morning, and when I was doing a lecture with my son on Monday and today, I was giving the criteria that I felt that Monday's trading would see it trade up to see it trade down. And the boundaries, okay, were based on the opening price of this last close candle and the wick down here, okay? So if we're up here and we're trading potentially lower to get into this discount wick, we have to at least be aware of the upper half because it could come down here just to that level and then turn bullish, okay? Only until we close below consequent encouragement do we then refer back to this area and only use the lower half. So it's trading down into the upper portion because the upper portion is going to show discount sensitivity. And it can kind of like build the basis of around a short-term swing low or an intermediate term or long-term low. Okay. So those are the two frameworks there that you'll see on the charts when we go forward. This is the discount daily wick. These are the levels based on this right here. And then this is the order block, which will be the change in state of delivery. Now, let me just say this. Some of you are going to say, well, look at this candlestick right here. This is a larger body candlestick than that one. And you taught recently that wouldn't this candle here be the change in state delivery at its opening price? Yeah, if we ever trade below it, but we're inside this range. So we're content with using this, okay? That's my order block theory. It's not supply and demand, okay? And it's not dollar menu mentorship view of order blocks either, okay? Just because they use my term doesn't mean they understand what an order block is or how to properly use them. All right, dropping down to a 15-minute time frame, those two boundaries or parameters from the daily chart, this is what we have, okay? So buying in and of itself, keeping everything naked except for these two reference points, we have a old high, so there's buy-side liquidity resting above that. We opened yesterday on Monday at 9:30 Eastern time. Here, it traded down and immediately shot up, took out the buy side here, went up into this gap, which you'll see in a moment. And I stated when I was lecturing my son, I told Caleb, I said, and you hear this in the recording also, I want to see it try to gravitate to consequent encouragement of this gap and then make an attempt to roll over and go after that sell side, okay? Now, I know that sounds just like me cherry picking. It's all hindsight. Oh, of course it's hindsight now because I explained it before it's going to happen, and now you can see it on your chart. And it trades right down into that discount wick on the daily chart. Look at that. Isn't that brilliant? Got to admit, folks. Isn't that nice? What if you spent your time looking every month, okay, throughout each trading day and every week and every month, just looking for a short-term, one-shot, one-kill type setup? Because my trading is done for the week. I'm going to be doing lectures the rest of the week now. Okay. Usually it breaks the heart of everybody because they're like, okay, he nailed that perfectly. Now, what's the next move? What's the next one? I just gave you the entire run in June on several markets and it delivered like gangbusters. Now, I want to try to transition to one shot, one kill. Just to show you, again, I haven't forgot how to do it. I gave everything openly and public before the fact. So watch Monday's video, look at Monday's tweets before the market started trading in the opening range at 9:30 Eastern time. So you had all the information there beforehand. When we got up into this level here, we were reaching up into this inefficiency. So let's add a little bit more lipstick to it. So that fair value gap there and this sell side liquidity pool is what I was framing. To go up, to go down. Okay, so it's this area here, focusing on the draw to this relative equal lows, that's the sell side liquidity, to arrive up down here below it and reaching as far down into consequent correction of the daily discount wick. Now, I wasn't interested in being in a position that deep or that low, but that's the framework. So what would be a low-hanging fruit objective? Just getting to that low. Or, as I mentioned in the analysis and commentary, this would be a low-hanging fruit objective if it could just get down to that, and that was fine. And you can see it did, in fact, act as an inversion fair value gap and trade lower. And we talked about this one as well in the recording. We have this SIBI, price utilized that and utilized that once more, hammered the old low, sold off. So this acted as an inversion fair value gap, and this acted as an inversion fair value gap. And then once it got down to our daily discount wick on the daily chart and swept that sell side liquidity, look how fast and sharply we returned back inside that range. What range? This one. Okay. So you have to know what you're looking for. You have to blend some time frames. There's nothing wrong with waiting for setups to frame around the basis of a daily chart. That's the easiest, strongest delivered price runs you're going to trade. If you can't structure or frame an idea from the daily chart, then you need to probably sit on your hands because you're looking for some kind of a fluctuation intraday, and you might be right sometimes. And that tricks you into thinking you're way better than you really are. And just because you have a model and a structure that puts you into a trade, that might not be the case for what the market's actually doing because you're looking for something that may not actually be there or materialize because the market can stay in a consolidation. It can hem and haul around in very small ranges or just be lethargic and simply just say, I'm not going to participate in what you expected to do. It doesn't mean your model, is inherently wrong or that you're a bad trader, but it does make you a bad trader if you continuously force your will in the market, insisting that your model speaks, from a buy side or sell side perspective when the market just simply is not willing to yield to that. So let's go down and remember the follow-up video I did yesterday. I said these relative equal lows here, I want to see them get taken out and then build momentum and then work through that low. And then we'll see if it wants to run down into this inefficiency and take out that minor sell side. It did. This was where I was drawing everyone's attention. Initially, I want to see if it can get up there. And then once it got there, see if it can produce a run lower. Smart money could accumulate shorts in here, right at the consequent encouragement or just above. And then we had this nice little gap right here. This is model 2022. Okay, so we have a swing low here. Market trades through that, comes right back up. Model 2022. Okay, or you can just simply refer to it as my oldest model on this channel, the ICT Optimal Trade Entry or OTE. Same criteria there. Okay, and then low-hanging fruit objectives will be here and here. And if you want to leave a runner on based on what I was sharing in my own analysis, that gap and then the sell side down there. Okay, so it really delivered handsomely today, just brilliantly, and you can't really argue that that was a nice price run. All right, intraday, you can see how we rallied up yesterday, and then today we had a little bit of a continuation. But this is the setup that turned in that. Let me go back up one slide. This is yesterday's price action. Right here. We're focusing on all on this right there. Okay. Now we're zoomed in that perspective. So we have relative equal highs during lunch macro, 11:30 Eastern time to 1:30 p.m. Eastern time. The setup usually forms in the first hour of that 2-hour lunch period. Okay, so between 12:30 noon to 11:30 a.m. Here's your buy side during the 11:50 a.m. to 12:10 macro. That's when the algorithm will start to do its work. It'll start spooling. You want to see it show a willingness to take out opposing liquidity. Here's buy side, hammer it right there. Smart money gets short there, and 10 o'clock low right here. That's my ICT lunch macro. It's algorithm price run, and in the afternoon, if it doesn't deliver here during the second hour, just hold for it to go into the PM session, and it does it so here. Okay, trades down into first percent of fair value gap right there. Look at the bodies respecting the consequent encouragement level. So we have like a failure swing to get below. Then price pulls back up into the range. We have relative equal highs now. So we'll see going forward. There's relative equal highs. The market makes that return back to lunch macro, which is a 10 o'clock low. And I have a video on this on my YouTube channel, so just look it up. The market rallies up, then uses another previous gap we've been talking about, rallies back up, clears the buy side liquidity. And here, smart money can add to that. When it drops down, they could add once more in here on this SIBI. Aggressive break lower, clears up relative equal lows here, trades down into an old swing low. That's what this blue line is. But we have relative equal lows down here as well. And it still is based on the Monday lunch macro draw. So it's based on an old pool of liquidity that framed new relative equal lows. So that's going to be very suspect. It's going to be more likely that the algorithm will draw down into that. So the market just goes sideways in here. Rallies up, creates this little run here, consolidates, and then we drop down, taking out those lows there, and treats this as an inversion fair value gap, which is first presents the fair value gap from Monday during the opening range. Here we are with that same first presented fair value first presented fair value gap. Good grief, it's a tongue twister. We have buy side being taken here, breaks lower, breaker, sells off overnight, works lower. We have a 15-minute SIBI here, so you can't really see it on the 1 minute chart, but I shared it on my post today, and traded lower into 1:30 a.m. overnight, then rally back up. This inefficiency you'll see on the 15-minute time frame as well. Here it is as well. Pulls up into the higher level of that SIBI. Looking on the 15-minute time frame, you'll see these two levels. Okay, and then breaks lower, consolidates around till 7 o'clock in the morning. We rally up, and then we have a suspension block, which is bearish here. So we have a volume bounce at the high, volume bounce at the low. We break back lower, and then we're entering into the 9:30 opening. We have a suspension block, which is bearish here. So we have a volume bounce at the high, volume bounce at the low. We break back lower, and then we're entering into the 9:30 opening range. We have relative equal highs here. And during the lecture with my son, I said to him, I said, we were likely going to see it pull up and clear this area here. And I didn't see this one. I've got aging eyes, folks. But during the lecture, you see me actually refer to this. I said, I'm going to see it try to wilt. And I noted that the bodies were staying inside of the gap that's shaded in orange. And all the wicks were just simply doing the return back to here. And it was respecting the lower half of this big premium wick. So in your charts, you want to be able to split that in half, find the consequent encouragement level. You can see that the wicks and the bodies were simply approving that there was no interest in it going higher. So that's not selling pressure. That's not abated buying pressure. It's just simply the algorithm saying, I'm not going to keep spooling higher and offering higher prices. It's done its work. So smart money can see this visually. That's why it's important for you to stay on an open, high, low, and close candlestick. Don't augment the price because you're literally gambling and guessing. And I don't care who tells you. Okay, there's a whole lot of people out there that's been proven unprofitable with all these manipulated candlestick creations. It's nonsense. Okay, but remember, I told you this stuff yesterday during Monday, and then it delivered perfectly. Okay. Here you'll see that I actually during the lecture this morning I actually drew this out with my son, and it wasn't accurate. There's a small little deviation from this candle's close and this candle's opening, so it is a volume imbalance. So it should be drawn like that. Okay, you can see that's what happens here. Trades up to the high of that. And that's not me going back and form fitting. I just looked at it closer because I'm taking the time to create the slides here. This is, again, what I drew incorrectly, but now this is the correct perspective. Usually, folks are real quick to say, you didn't draw it right. You didn't have the volume imbalance in there. They like to teach the teacher or correct the proctor, right? So in this case, I didn't see anybody do it yet. So if you do get to the video, just know that I'm correcting it in this one, okay? So now this is correct, and the annotations are as they should be. The market went lower, and I said that this should be treated as an inversion fair value gap. Now, you have to do your own due diligence. These videos are not long. So if you're not knowing what this gap is, just look at the prices and go back to the beginning of the video, okay? And you'll see where they are in proximity to these prices. And you'll see that their parent and subordination role, there's an hierarchy to them. And even though we had a little bit of a body on the upside, the wicks were not able to do any severe reach to the high end. All of the volume is represented by the bodies of the candle. We don't need to see any kind of numeric value. We don't have to look inside the candlestick. The candlestick's going to show you, okay? And it's showing that all of the volume is in the lower half of that inversion fair value gap. So there's no footprint needed, no volume profile, none of this nonsense, okay? They're all gimmicks that let you think that only by looking at it that way can you see what, I guess, more invested or more informed traders are doing or have done. And again, that's tantamount to whatever the weather was yesterday between 11 o'clock and 1 p.m. You know, that means that we're going to have the same temperatures today between 11 o'clock and 1 p.m. That doesn't mean anything. In fact, where I am locally, you know, if we were using that analogy or assumptions, it would be incorrect. It's significantly cooler here today. So the market trades lower, uses the inversion fair value gap here, as I expected it would, and it went down, took out the sell side, and then went all the way down to the discount wick. Now, I'm okay with not being a participant on a move with the last portions right here, especially with the market conditions that we have and have had for a month or so, or sorry, for a year or so. The volatility has been unbelievable, relentless. You know, in the first 45 seconds this morning, we had over 100 handles here on one single 1 minute candle. You know, that's enormous. It's just, and it happened just like that. So if you're trying to trade with large position sizing, with no stop loss or no idea what you're doing, you can get wrecked real fast. So a lot of the, you know, affiliate marketing goobers that like to talk a whole lot of talk, you know, the real inner circle trader, right? Listen, he's trying to go long here. He wants to buy that when we were looking at this as buy side liquidity being taken with the expectation it was going to draw down here. Okay. So these guys need to keep their mouth shut because they're just embarrassing themselves. And we end up using this fair value gap. It bumped the bottom of the inversion fair value gap here from previous lecture on Monday. and then rolled over and delivered perfectly. Look at that run from here where we were annotating the buy side being taken, dropping down and delivering right as Pop would say, bullseye. Okay, and then the market goes consolidation like this. After it hits this, it's strongly likely to see a retracement into the range, and it's okay. When you have such a high degree of precision and expectation be met, and you can do it in the first half of the week, be done. Be content with that. It doesn't mean you can't go into price action and study. It doesn't mean you can't go in there and demo trade and tape read or just observe. It doesn't mean that you take your hand off the wheel and say, well, I'll come back on Monday. You need to be involved with the market. But from a trading perspective, okay, you see these guys out there, they're doing like huge 6 figures in a month, okay? And this is a 6-figure day rolling from yesterday to today based on the analysis I shared. And imagine if some old guy, some old fraud, if he had like 20 contracts on the hottest little prop firms out there, could you imagine what he would have been able to take in from that? Good grief, you definitely would have never seen a payout from that guy. It would have put him in live right away and denied it. So here's the, I know I went there. Here's your low, rallied up, fell back in, and then worked back up into the inefficiencies. And look how much time it spent in this area in here. Isn't that interesting? That's one of the things I look for to tell me I made a good decision by not participating any further, because it starts doing, yes, there's a event horizon with this fair value gap low and this fair value gap high. So midpoint between these two gaps. You'd split that and show that right here. It's gyrating around that, but it's also just doing it in a time where I'm not interested. I don't care to do anything more because it's not a perfect run for me. Like, this is beautiful down here. Why would you want to push the issue and demand more from the weak? I mean, think about it. It's several hundred handles. It's brilliant trading. It's brilliant model being implemented, brilliant analysis delivering to the tick, all things hammering out, all inversion characteristics being delivered as expected. Like, it's wonderful. And the worst thing you can do as a trader is when you fall into profitability is to assume that consistent profitability is every day big volume wins or every day trading. That's not it, folks. That's not it. Okay. Can you trade every single day? Yes. If you're trying to be a scalper, there's all kinds of little small little bread and butter scalping scenarios. I've taught that. That's on this YouTube channel. Okay, lots of those things with complete rule-based ideas from nuts to bolts, start to end. It's all there, regardless of what these guys want to tell you. It's all here. But I don't know what your model is going to be. You don't know most of the time what that model is going to be. You don't know what you want to do until you get in here and you lose a little bit. And then you discover that, well, maybe I can't be a position trader and trade intermediate term price swings on a daily chart or weekly chart. Let me try short-term trading. Well, what I just did today and yesterday, that's short-term trading. That used to be my one shot, one kill model. I would look for 2 to 5 days a price run and be out by the end of the week. Before things got silly, I didn't have a problem holding over the weekend, but I would not hold anything over the weekend now. The gap risk is absolutely ridiculous. So short-term trading is getting in above 1 day's trading. So in other words, if you enter one day and the session closes and restarts at 6 o'clock, as soon as you do that, that's 2 days trading for me. So that's like short-term trading. Day trading is any time before you get out before 5 p.m. Eastern time settlement. So with that, hopefully it was a worthwhile observation on your part the last 2 days. I want to teach a little bit about how to make your way through this industry without having to delve into prop. When I say prop, it's the sim trading prop, not a real prop firm where they give you real money and you can split it with them on agreed terms. Um, I understand there's a lot of folks out there, a lot of my students do very, very well with the whole simulated prop stuff. But there's a whole lot of you that have an opinion like mine that you just simply don't want to touch it. And what resources, what avenues, what approach, if I were starting all over again and say I was working at a pizza shop delivering pizza. I'm a young guy. I don't have any kids yet. I don't have any obligations or dependents. And maybe I'm roommating with a buddy or two. Okay, so my bills are not as bad as they would be if I was on my own entirely, but let's say I'm a roommate with 1 or 2 of my friends, or I'm in university, okay, and my only income is a small job delivering pizza and it's not much money. Okay, how would I go about starting and building it from that? That's kind of like what I want to spend the rest of the week. So Wednesday, Thursday, and Friday, and if I can wrap it up by Friday, that'll be it. But if not, I'll move into Saturday and Sunday to nail it down. And that's what we're going to focus on for the rest of the week. So until I talk to you tomorrow, Lord willing, be safe.
Peace. Now we're going to go back to that. I just want to have a glance at his strategy these days. Let's go back to the here.
Retail, the less informed traders. Okay. Well, if they're buying it, who's providing the other side of the trade? The smart money. What? Yep, the smart money. They're selling it to them. Lock, stock, and barrel. Okay. Who's going to win in that arm wrestling match? The elephant or the child? The little kid in the swimming pool. It's going to be the elephant. When that elephant gets in that pool, boom, the kid is taken completely out and the water is displaced. So what do we see? displacement. Okay, price is now driven lower. Okay, those that would have been trading what would be whatever their idea of this is a climax reversal or something along the lines that would support a buying indication in here. And again, we're not arguing or making any case for that, but we're just going to assume for a moment that somebody out there in the retail world assumed that that level was probably a good area to buy. So if they bought here, where would their stop loss be? Right below that. Okay, so price is driven where? To where the liquidity is going to be, here. Okay, so here we have price trade down and trade right back up to what? This level. Now it becomes another selling opportunity. Who's going to sell? Some more of the smart money. So they're going to put some more of their orders in, and then boom, it rides lower. Okay, this short-term swing low here, because we're not drawing levels on it, okay, you can look at a lower 5-minute chart and see even greater dynamic support and resistance levels, but I'm using the 15-minute chart simply because you'll learn later on that your trade setup's really going to form on this time frame. But we're going to keep it uniform and keep the continuity going, and we're going to use this low here, price trades up to there, and once we blow through it, we trade through it again, okay, but we come right back up into this old swing low here. So I could have another level, but to keep it clean on the chart, I'm just going to keep it, just like you have here. Don't expect, perfection in terms of your support and resistance levels. Sometimes they'll knock your socks off and be so specifically, right to the minute on the pip. But we're only talking about here 14 pips in terms of variance. So again, that's less than half of what my normal stop loss is. Again, for those who don't know, I usually trade around with a 30 pip stop loss. And again, we'll understand later on why I use that later on. Again, not now. So we move into a new week, okay? Price rallies up, and this little pause here and turn down happens where? Look over here. See that? Okay, so price trades down. Okay, find some short-term support, which we're not going to look at because it's going to be on the 5-minute chart. You can do that on your own. Rallies through, okay, and does what? Blows out a swing high. Why? Because maybe at this point, some guys have figured out this is in a down move. Okay, so they're going to be doing what? They're going to be selling. Yeah. Those guys sometimes in the street, okay, get it right. But do you think the elephant really wants them in the pool with them? No. Okay, so what's going to happen? Well, they're going to be short, okay, and they're going to use this old high as a level to do what? Protect their position, right? Even if they're selling down here, or maybe they saw this low here and they want to be a seller right there. Great. What are they going to use as their stop loss? It could be this high here or this one. So let's take a look at what happens. Here's your old high. And we're going to use that level, and we're going to just go above it a few pips, not much. Here you go. When price trades right there, the nature of the spread does its work right there. What order would be resting here? Again, assuming that the retail traders are short. There's going to be a buy stop right here, a buy stop. So when that price trades up and boop, stabs into that level here, what's going to happen to that buy stop? It becomes a market order to do what? Buy. Who's going to sell it to them? Smart money. And then when you see price rally up like that, bang, what do? They drive it down to their level, okay? And now this is where they liquidate all their short positions back here. Now they could have, liquidated some in here, okay, and that's what caused the pause in here, because now they're buying back some of their net short position that they've assumed between the 130.60 and 150 level up here in this block of price action. But as price trades down to this level here, okay, they're essentially now no longer heavily net short. They may have some shorts still on, but essentially they have been unloading every time price dropped lower, okay? because they're larger institutional traders, they have to be exiting during the move, but certainly driving price down to a specific price point, as we noted on the higher time frame. Now, when price gets to these levels here, we could look for patterns to trade, because again, this would be a higher level support level. Okay, and then you can see price does indeed rally up. Okay, and for those that had been using these points here, okay, and trade on a daily time frame, because there are 9 to 5 desk jockeys and they can't be intraday traders, so you use daily bars to put their stop loss orders. Okay, those guys are crushed as well and left feeling bewildered and like the game is rigged. And you just learned that it is, in fact, it is rigged. And but there's a means of understanding how it's rigged. Okay, let's look at these specific times when price moved. Okay, this high here takes place at 1445 GMT, or 1500 rather, 1500 GMT. This high here takes place at 1500 GMT. This high here is essentially 23, what is that, 2330 GMT. And this high here is 11 GMT. This high here is 12 GMT. And the high here is 630 GMT. That's early New York, early London Open or Frankfurt. This is New York Open. This is the very beginning of New York Open. This is Asia. This is London Close. And this is London Close as well. So you can see there are specific turning points that are occurring at session open and closings. Okay, and I promise that we're going to go into great detail as to what those specific time pockets are. Okay, and in my trading I call them kill zones. It's not because I'm supportive of serial killing or the notion of killing people. I adopt the mindset of a sniper, but I don't have you know, suicidal or psychological issues where I'm attracted to killing. Okay, and so don't think that's what this is. I just use it to adopt a specific mindset. Okay, and I view trading as a sharpshooting exercise. Okay, much in terms of a sniper. So it's not that I'm supportive of going out and shooting people. I'm supportive of the idea of being a marksman. Okay, so please don't send me nasty emails or leave comments that I invariably forgot to turn off on my YouTube channel, making comments about how I shouldn't be supporting the war or anything like that. So please, don't run with the idea of the sniper theme, okay, and think that I'm supporting the killing of human life. But a lot of the themes I use in teaching comes from my way of learning. So I had to create a language for myself to understand what it is I was seeing in price action. And then also it is valuable as a means of communicating or creating a vocabulary, because a lot of this stuff, it came through just staring at charts. Now, when I do get to concepts that I learned from other people, I will always give credit to where credit is due. Okay, I believe that should be always the case, but you see many times, and I've seen my own work, okay, appear in things that you could buy on the internet. And I just recently bought a new course, and I'm not going to say who it is or what it is in this video, but I was very disappointed to see something of mine, and it is uniquely mine, and it wasn't credited to me, and I'm very disenchanted by the whole thing. But yeah, I might talk about it later on, but certainly not going to bring it up in this video series. But if you do see a concept in this video series that I personally learned from someone else, I will certainly do my very best to give them their credit as well. Let's look at the notion of fractals in price action, and we're going to move over to our second portion of price action and study this segment of price. Okay, this is the second portion of price that I was asking you guys to study. And what I have here is I have the price levels on the 15-minute basis, because remember, we talked about how price is universally limited to trading within support and resistance levels, but each time frame has its own support and resistance levels created as price gyrates up and down. What I did here, and this is certainly not every single one of them, but what I want to draw out with your eye is I want you to see there's a specific overall price structure here. Okay, now this concept is not going to be fully explained and understood by watching this one video, but if you spend time in the charts yourself, you'll start seeing these things repeat over and over and over again. And it's one of those things you have to keep looking at it before your eye gets accustomed to seeing it, and then right away your brain will do the magic, okay, of seeing it, remembering, oh yeah, this is what this is, and then boom, you'll know naturally what you should be doing. And that, again, I'm not talking about trading with your gut, okay, this is what you do with your eye, okay, you're trading what you see. Price trades off of a level of support. Okay, and we're just going to assume that the 132 figure was significant enough to provide support, and price rallies off here. Okay, price comes back down, trades down into that 130 to 30 level, essentially. Okay, and bounces and runs through and creates a short-term support level. Okay, now price has since been trading higher from that low we discussed when price came down in our previous example on the higher time frame where we found that support level. Now as price moved higher, okay, you can see this stair-stepping environment that you can see price doing, and eventually it reaches a level of resistance. Now we're going to show why it's a facade on your part to look at these lower time frames and expect with any reasonable consistency to be able to see what's going to transpire next without having any idea what the higher time frames are doing. Now on a short-term level, okay, short-term basis rather, with the higher time frame premise in mind, until a higher time frame barrier is met, and this is going to be in the form of resistance, okay, and that would be seen up here, which we'll look at in a moment. Until that is met, that barrier or that obstruction to higher prices, one could capture trading opportunities when price is finding support. Okay, so I'm very well known for what I coined as the optimal trade entry, which is simply nothing more than a Fibonacci retracement back to the 62% or 79% retracement level, or my own level 70.5, which is between the 62 and 79% retracement level. They have a very consistent level of reaction in price when they are hunted. And I'm going to give you some examples on how, just by using this price structure here, okay, how many times you can see these, these signals setting up. Now, again, we're looking at the first week of August, okay, the first week of August, and again, we're assuming, again, that the market is still bullish, so we'll be looking for the low of the week, okay? Now we reverse the script we learned earlier about the trading day of the week. For down moves, we expect to see the high of the week formed by Tuesday's London Open, or Monday, and the very latest by Wednesday's London Open. But 70% of the time, you see the high form on Tuesday, or the low form on Tuesday. In this case, the low of the week, okay, because here's the end of the week, here's Friday's close, here's Monday's open. The market opens on Monday, trades lower. This is the low of the week, okay? Write this on your notepad. When there is a large range bar, okay, whether it be a daily or 4 hour or 1 hour or 15 minute, it really doesn't make a difference as to what time frame it is, but whenever you have a large bar or a large candle, large candles on any time frame do not usually work both sides of the opening of that candle very much, okay? And what do I mean by that? Well, we're going to use this example here. The market opened on Monday on this particular week. It trades up a little bit, but we're not talking about very much here, okay? Let's look at exactly what we're looking at here. It's moves up 25 pips. It moves down 42 pips, okay? So it starts off going up about 20, goes down about 40, and then starts to move higher. But notice it doesn't work both sides of the opening very much. If we're bullish, we can reasonably expect to see any decline be very modest, okay? So we could be a buyer on weakness with the understanding or level of confidence that if this is a bullish week and it trades lower, okay, on Monday or Tuesday, we could be a buyer if it finds support, okay? But now prior to this price drop, I'm going to ask you, what do you see here? Now we're looking at the 132.30 level here, but again, because we moved down to a lower time frame, what other level stands out? You see this high here, the short-term high? Let's note that. Now I will admit it's not very much in terms of difference between here and here. Okay, this level, let's note it so you can see what it is. It's the 132.26, and this is the 132.30 level. So it's not much in terms of pips, but if this was an hourly chart or a 4-hour chart, this could very easily be 50, 60 different, any number of pips that's greater than just less than 10 here. So again, I'm trying to take your eye and train it on a conceptual basis and not limit it to a specific time frame, okay? The things that are generically inherent or sensitive to time frame is the higher time frame, the daily, 4-hour, and 1 hour. So the trend, the directional bias, the higher level support and resistance levels, those things don't move. They're very, very, very powerful. They're static. You have to directly relate them to the higher time frame. Again, daily, 4-hour, 1 hour. No trade whatsoever. You should never take a trade outside of having a key support level or resistance level that is either from the 60-minute minimum, 4-hour, or daily chart. Okay? If you do this, your trading is going to move to another level immediately. But it's also going to force patience, which is a very hard characteristic for traders, especially as a new trader. You're not going to have that level of patience, okay? But by applying the higher time frame support and resistance levels, it's going to force you to wait. And that's a good thing, because that's a characteristic of good trading that has a learned characteristic. We don't open a book up and say, okay, I read that chapter, now I'm patient. No, you know what I'm talking about. I mean, you know, you've had your demo accounts, you've over leveraged it, $100 per pip just to see what would happen. You know what's going to happen. Nothing went in your pocket. You wasted time, and if it lost money, you didn't pay attention to that one. But the ones that do, you're sitting at work daydreaming. That's the way you're going to get out of having to ever have to work anymore. Okay, so you know what you did, and you know what you do all the time. So stop doing all that mess. So now looking at this price action here, okay, we have this short-term high here, okay. We have these swing lows in here, okay. So what in this block of price, what level in here is being worked? Any idea? The 132 big figure. Okay, 132 big figure. So what we'll do is we'll just move this down. Okay, and what I'll do is I'll take this level, and I'm just going to put that here. Okay, so we have a price level that's being worked here, and we have a very short-term high here as well, but this retracement here, okay, you see that? We're going to introduce briefly, I don't want to do too much of this because I can very easily turn this into a 4-hour teaching just on fibs and won't even scratch the surface on what's applicable with it. But if you pull a fib from that level, okay, this is the support level. Okay, we have price here rallying up away from it, making this high here. Okay, you see that? Do you see now, let me put this right on the level because I want to be consistent about what I'm showing you. This is the 70.5 level, this is the 79% level, and this is the 62% level. Price comes down to 62 and bounces. And then what does it do? It rallies off, trades up into old lows, old high, resistance, into Tuesday. Okay, Tuesday trades down, it makes a low. The low here comes at 6:30 GMT. Think in time of day. That's middle of Frankfurt, the very early stages of London Open. Okay, just go back here for a second. The low on this day here forms at 13:45 GMT. The high of that day, on Monday, forms at 7:45, which is London Open. So now we have another minor move here in retracement. Okay? If you pull a fib from that, price swing from here to here, and I'm going to take this one off so you can see. Price comes right down to that 62% retracement level. Now we're hunting or stalking buying opportunities, okay? But the 62%, what else could we use, okay? Well, let's see what else happens around that 62%. We have the 132.47. So isn't that really the 132.50 level? It's a big round number, right? So you can see price comes down to that mid-figure level and then bounces. So there's a confluence of support like that, okay? Now price rallies up, comes down, bounces here, trades up, finds a high, and retraces to do what? Well, this old high here, once it's broken through, it becomes an inversion level again. It's resistance here, once broken, okay, its roll is inverted, now it becomes a support. Rallies off, okay, and then comes back down on the very next day. So you don't have to rush. If you miss this move, fine. Then you start seeing on Wednesday price retraces, okay, and you would do what? Expect it to find support where? Here. But now watch what happens. You take your fib and the previous day's low, pull it up to the high. This is the highest point from this low to this high as it retraces. Do you see what it's done here? Here's the 62% retracement, the 79% retracement level. We have a confluence of support and resistance on that 70.5 level or sweet spot. Okay, this is like that target crosshair on a sniper scope. This is exactly what you're looking for. The very low of this candle, okay, comes at exactly at 9 GMT. That is the London Open kill zone. Price rallies up, takes off. Okay, breaks through this old high. Okay, see that old high here? Breaks through that. Let's take our fib that we had drawn here off. Okay, price rallies through it and comes back and does what? Finds an inversion level. This resistance broken. The roll is inverted. Boom, it becomes what? Now support. Okay. Now I'm going to refrain from breaking down to a 5-minute chart just to show you the optimal trade entry here. But you see this swing low here? This is London close. This little swing low here. This occurs at London close. Write this down on your notepad. Every session high and low, in other words, the highest high and the lowest low it makes during each session. Okay? That means the London session, the New York session, the Asian session. Okay? I only look at those three major trading sessions, and you want to be looking for the highest high and the lowest low. And it's easiest to do that research on a 5-minute basis. Okay? And you want to be getting used to seeing what those ranges are for those individual sessions. Now, when you use that information, you'll be able to pull your fibs from these particular price points, and you'll see the signals that evade many people. And a lot of times people watch my video and say, well, it looks like hindsight to me. You'll see that this is the same stuff applied over and over and over again. Okay, so we have a low here, which is old highs here on Tuesday. So these are all lower level support levels that are now dynamic. So this level is good, but you can fine tune it also. Okay, but more importantly, as price trades back down to this level here, I'm going to show you. This is the high and the low, and here's the 79-cent tracing level lying right on top of this support level. So we have real support resistance with overlapping Fibonacci, 79-cent tracing level with a directional bias in mind, looking for higher prices. Okay, so you could be a buyer on this candle here, and this candle comes in at 2:45 GMT. So you guys that work all day, you could have been a participant on this move. This is a Asia session trade. Price moves up, blows through a short-term high that it creates on this day here, and meets a otherwise unknown resistance level. Okay, do you see the facade here? If you're just looking at these types of charts, 15-minute basis, if you're looking at sub 60 minutes, anything less than 60 minutes, without having a reference point on the higher time frame, you really are throwing darts in the dark. You have no idea what you're aiming for. Okay, you may think you know what you're doing because the price is trading up, and maybe you're drawing trend lines and all that business. Look, if you don't have the higher time frame premise in mind, you are gambling. There's no other way of saying it. You're just simply gambling. So now we're going to look in a moment at what this catalyst was, okay? And it's going to be very clear to you. It won't be like, oh, this is hindsight picking it. You're going to see it's so clearly obvious why it turned here. But eventually price does break down and trades down, breaking all of the higher highs, higher lows, higher low, high, and it's all broken here. This low is broken here. So now we have a break in market structure that we're going to learn more about in later modules. But as price breaks down, okay, this support level, as we see my little bounce here, price comes down, breaks through it, and trades right back to it now. Okay, so now if you pull a fib from this high to this low, you can start seeing overlapping, and you can do this on your own chart. That's this video is getting very long. You can see there's this selling opportunity. The candle here comes in at 6 GMT. This is Frankfurt opening, the very beginning of Frankfurt. Price trades down, finds some support. Okay, if you just look over here where price starts to take off in here, this little pause or consolidation, it bounces right at that same point, comes up and starts making a larger range, okay, and creates a tap to this old swing low as resistance, and then trades lower and breaks through this swing low, trades softer, right back down to old lows that I did not have on the chart as a horizontal line. It bounces, trades up to a known level of resistance, okay, and comes back down and starts consolidating. But it's consolidating around that 132.50 level. So let's just calibrate our level here. Okay, we're going to leave that there. And I'm going to take this one off just so it won't be confusing to us when we go out to a higher time frame chart, because I want to illustrate what it is that's transpiring here. And now up here, if you look over here on the left, I'm sorry, on the right hand side, this is essentially the 134 figure. So what we're going to do is we're just going to highlight the 134. Okay, and it was 133.98 was the high that day. But we're going to see there's an actual high on the higher time frame that this would have been utilized as a reasonable expectation to expect price to be either pausing at that level or maybe a little bit above it, excuse me, or below as we have here. Now we're going to drop out to a 4-hour chart. Okay, and here is that level right there. Okay, do you see these old highs? It's essentially worked that 134 figure. How about this old high? See that? Let me take these vertical lines off. And sorry, but I got to get this off. It's just driving my eye right to it. You can see that price slipped aggressively right there, and as price ran up to that old high in here, it's reasonable to expect that at least this would be a pause or a reversal, and you see that. If you go back farther, look at these highs. See that? How about if we go out to a daily chart? Here's those highs we just looked at. Look at this high. Look at the lows here. See the highs here? You don't think that level's sensitive? Okay, you saw that here. Okay, so again, let's go back down to the 15-minute chart. Price trades down from there, okay, until it does what? It finds support. Okay, and this level in here, we're just going to borrow this horizontal line, and we're going to use the very extreme. Okay, now this is illustrating again the facade of using lower time frames to justify the trade without having a higher time frame premise. Okay, we have the 132.10 level. This is essentially what that is, and that's a level that I've talked about in weeks since this time of this recording. If we got to a 4-hour chart, here's that 132.10 level. Okay, price comes down, hits it right there, rallies off. Look at the time it spends at support and resistance at that level. See that? Okay. When price trades down like this and rallies off, go back down to a 15-minute time frame. It was in a consolidation. So I was asking you when we were doing our first episode what you saw here. Okay. Now this is the market maker business model. Okay, and we'll talk more about this as we go along, but we generally see a consolidation, a rally, a retracement, then another leg up, and a pause, and a leg up, and an eventual reversal with a failure swing. In other words, there's a high, it fails to go higher, and then it breaks down. Then you start seeing the market move lower with opportunities to sell. Okay, there are really 2 legs up and then 2 legs down, and there is a zenith point here, there's an origin point here, and a conclusion point on the right side. Okay, they build a block of orders. Okay, they rally the price up. They is the dealers, okay, the market makers, and then they have another leg up. If you look at price very generically, if you say, okay, here's the low, and it rallies up and makes this price swing. Essentially using this low here. This is the second leg here. Okay. Now we're not looking for perfect symmetry, but the overall price structure will always be very similar to what you see here. the price move lower. Okay, we have a high down to a low. Okay, you can see the second leg here. Okay, so we have price move and then consolidation and another move lower. So that's the second leg. So there's 2 phases up, 2 phases down, but there's a reactionary high that's formed here. Okay, so they rally price up and then they sell off. So the accumulation, they accumulate longs here. They rally price up. As price is rallying, they distribute, and then they start selling on the other side. Usually what happens is folks over here are expecting it to continue, and they're buying over here. Because why? They're looking at lows over here, drawing trend lines, and they're thinking, okay, it's right at the trend line, let's start buying it, and then it breaks. And then they don't know what they're doing. So much in the same way it does it on the upside, same thing will happen here. Folks start seeing these stair steps going lower, lower, lower. They'll draw their trend line. Again, this is why I'm not a fan of trend lines, but you can see how this is a very textbook trend line. So when price gets here, okay, let's be a seller. Really? Why? Because the 15-minute chart says so, and it's a trend line. Watch what happens. Wow, we've made money. Boom, we got crushed. Watch what's happened, okay? We move into another market maker business model. We go into a consolidation, a fake rally, and then they take the stops out on those that are right on the market. So they could have been buyers down in here, okay? There's could be retail traders that were being buyers down here, and they would have been right. Bang, you take them out. It activates their sell stop. Their sell stop becomes a sell order at the market. Who's going to buy it from them? Smart money. And you see this extrapolated huge move rally up. Okay? Now think like way over here. We have a consolidation, a rally, and then a consolidation, a rally, a consolidation, a rally, and a reversal of sorts, and then a breakdown. Okay, let's look at what we're looking at here. We have a consolidation, a rally, a consolidation, a rally, a failure swing, and then market breaks down and creates a false rally, and we move lower. Move lower, rally, move up into old resistance, okay? And this is where we're at right now. So you can see there's a general repeating theme here, okay? They're not always going to be identical, but they're going to be very close in terms of their structure, okay? And this is what I refer to as market structure. You need to see what price is trying to do, okay, and key off of support resistance, use time of day, use day of the week, okay? And let's add that real quick here. You can see that the low was formed on the initial leg up, but you're now in the second stage, okay? And this is where we apply, it's more of a list, an advanced approach to utilizing, but you're also applying time. Now the study of time is important, okay? So you have this price rally here from the previous week, then consolidation, and then it rallies up. So this is when you get these weeks that, yeah, you do have a low form on a Monday or a Tuesday, it rallies off and makes a very good, potentially profitable trade. But then you have the reversal, failure swing, and it trades lower and takes out the weekly low. Why did it do that? Take the vertical lines off and take the barriers or blinders that you have on, thinking, okay, ICT said the week is bullish. That means it's going to be the low of the week on Monday or Tuesday, or certainly the latest by Wednesday's London Open. So therefore, buy and hold. Well, there's a little bit more to it than that, and that gets back to where are we at in terms of the overall market structure. Okay? So now we're on the other side of the business model. So now, are we going to continue move lower? Very well could. Why? Because we went up to that 134 and failed. Okay. There's a lot of other things that we could build on. And again, I'm not trying to give you a trade, but there's certainly a lot to suggest that this could potentially become a nice turning point. If you look at the high here, down to this low, It's a very significant retracement point, and we'll just leave that for another time. But if price continues to move on higher, then we can assume that this is a very solid swing low that's formed, and we could see this high challenge. But we don't know for certain. We just look for confluences of support and resistance with a bias in mind, and then trade on that. And overall, consistently applying that mindset, you'll see that there's as a means of finding consistency in your trading. Okay guys, welcome to in a series ICT Scout Sniper Field Training Guide. Okay, let's look at what we're going to be covering in this presentation. We're going to be reviewing the previous episode's assignment, price reactions, and we're going to be looking at examples of price reactions. We're going to go over a brief overview of smart money concepts, and we're going to be looking at interest rates, time frames, range trend, and power 3. Okay, we're going to be revealing the market maker. Okay, we're going to be looking at the ICT market maker buy model, and we're going to be looking at how dealers operate in support levels, and we're going to be looking at the ICT market maker sell model and how dealers operate in resistance levels. We're going to be looking at how market maker business model works in application. We're going to be looking at understanding how market maker pairs orders and how orders stack around key levels. Okay, we're looking at exposing the mechanics of a price swing, and we're going to look at more of the time and especially working around the ICT kill zones, and we're going to be looking at the London kill zone specifically and the New York kill zone. We're going to be looking at how price is crucial to you in as far as knowing your key levels and how you are setting up your opportunities to trade. And we're going to be giving you a homework assignment, stalking in the kill zone. Okay folks, we are looking at the Euro USD. This is a daily chart, and when we're looking at reaction levels, okay, the ones I'm most interested in are obviously found in the higher time frames. Now, you can go back to a monthly, you can go back to a weekly chart and look for these types of levels as well, but for the sake of this teaching series, we're just going to focus on the intermediate term market, and that's going to be divided at the daily and 4-hour. And by hunting the reaction levels on this higher time frame daily chart and or the 4-hour chart, it really puts the odds in your favor based on the fact that the institutional level traders, that means the banks, the large funds and such, they are really
watching these key levels. Now, we discussed in the first 2 episodes how we can look at support and resistance and have, high odds key resistance levels. Now, we're going to build on that in this episode here, but for now, while we're looking at this, I want to remind you that the last episode we talked about the fiber being poised to trade lower. Okay, now I purposely waited a little while, not as long as I did to put the 3rd episode out, but I wanted to wait a little while to allow the market to move lower based on that real time, if you want to call it that, in the recording that's time and date stamped on YouTube. The fiber was called to go lower. Now we're going to frame why that was the case now, okay, but I want to reiterate the fact that it was called lower beforehand. Okay, so the concepts that we're going to employ and go over in this example are going to be beneficial to you going forward, because it's the same type of thing you do over and over and over again, just on your own particular pair, or it could be a stock market, stock or a commodity, whatever it is, whatever vehicle or asset class that you find yourself a trader in. We're delving in specifically the FX market here in this series, but it's important that you understand that my concepts are generic, okay? And when I say generic, it means they're not boring in the sense that they're not useful. They're generic in the sense that they're universal, okay? They apply to every asset class. Minor little nuances that have to be taken into consideration, but nonetheless, they are applicable to every market asset class. So the homework assignment was to look for reaction levels, okay, mark them up on your chart, and then watch what happens in the coming weeks around those particular price levels. Okay, and we're going to do that now. Now, I'm not going to beat it to death in terms of what reaction levels and what support and resistance levels we should have noted on our chart, but if we were looking at this example here, and this was real time in the time of you sitting down in front of the charts, or when I would be sitting in front of the charts, this is how I would mark up my charts. Okay, and we're just going to use the full horizontal line just to save time, because I spent a lot of time monkeying around with adjusting the right end of a trend line. Now, I do like the trend lines because it makes it neater when I'm drawing horizontal support resistance. Now, I don't like trend lines on a diagonal basis, so don't get me misquoted here. I do not have faith in diagonal support resistance, but I do have absolute faith in horizontal support resistance as we have here. Now, what I'm doing is I'm noting every swing high and swing low that's relatively close. And we're going to use about 300 to 400 pip range from where we're trading at in this instance here. Now, obviously, you can see at the time of this recording, the price is already down here. But again, I'm going to counsel you to go back to the recording, and you'll know by watching it that we called this market going lower here. Okay, so we have this reaction high here. Okay, we have a swing high. Now, what I'm noting again, so you don't lose yourself amongst my banter here, I'm looking at times where candles have 2 higher candles on both sides. Okay, not 2 higher on each side, but 2 higher candles on one side. In other words, you have a candle with a higher low on the left and a higher low on the right. Okay, and I'm pointing at this, probably it's probably confusing because it's not what I'm showing you here, but this is a Sunday candle, so you got to take that in consideration and blend that into this Monday. So you do have the swing low here basing this Monday candle and this Thursday candle here, and this is a Friday candle. So you have that swing low. Okay, so we'll have that noted. Okay, and we're going to use this high here. Okay, and you see this one here? Now, I realize you're probably starting to think, well, wait a minute, this is getting really busy here. Okay, but what I want to draw your attention to is the fact that we do have these levels turning the market on a daily time frame. Okay, so if the market made its daily high or low there, okay, it's significant. Okay, now this is a moment where you pull out your pad. Major reaction levels, okay, occur around annual highs and lows. That means yearly high and low. Quarterly year high and low. In other words, every 3 months, okay, for instance, January, February, March, in that block of time calendar basis, okay, find the highest high and highest low, highest high and lowest low in that time frame. Do the same thing for the second quarter, okay, that being April, May, June, and then July, August, September, and then October, November, December. So those 4 quarters in blocks of 3, okay, because there's a quarterly shuffle that goes on, okay, portfolio dressing and such, and you'll be able to see significant highs and lows. And we're not going to do that here. This series is meant for you to get your sleeves rolled up and do some homework on your own, okay, and you're going to learn by doing it, okay. I'm leading you to the water, but it's up to you to drink, okay. You also have monthly highs and lows. Those are key, important reactionary levels, okay, and then you have weekly highs and lows, and you have intra-week highs and lows, okay. So in other words, once we get to like Wednesday, whatever the highest high and lowest low was at that time are influential, okay, and then you have your standard daily highs and lows, okay. And here is one of the gold nuggets that you're going to get, okay. Whenever you see a swing high, okay, a swing high like this, okay, we have a candle here with a lower high candle on the right of it and a lower high candle on the left of it, okay. This pattern is very, very strong, and the reason why it's so strong is because you have to take a couple elements out of that pattern, okay. And we're going to start with the first candle here. This candle on the left of the swing high, okay, you want to note the high, the open, the low, and the close on this candle. You want to do the same thing for the highest candle in the 3-bar pattern, and you want to do the same thing to open, high, low, close values on that same basis, okay. And whenever you see a swing high on your daily time frame, you really, really want to have those data points. Now essentially we have the high here with this horizontal line, and we essentially have the open, we're here with this line, okay, but it was based on this candle here. Now we have to have the low, the low here noted as well. Okay, you can see that happening right there. Now I'm eyeballing it, true, but we can go down and doctor it up when we get down to the lower time frames. But here's what I want, just by clicking that like I did here, I want you to take a look at what happened over here in these candles. See the bodies, they were having difficulty closing and opening far beyond that level, okay. Something about these levels, okay, causes the marketplace to turn, okay. And we're going to talk more specifically about that phenomenon, okay, and another smart money concept applied to where markets tend to blast off and have you a trade opportunity presented to you, and you can see things in advance based on what I'm going to share in this episode here. But I want to show you how sensitive these levels are. And then obviously, because we have this market open on this candle here, if you go over here, look what you did, you have a bounce right off of that. Obviously, we can see that the close of that candle and that swing high, we were opening essentially near that same point and went lower. The candle here was unable to make much move higher. We fell short of it here. The body of the candle here as well. Okay, so there's a lot of insight that is gleaned by doing these exercises, but it's also a daily procedure. Okay, but here's the cool thing. Once you have these levels noted, okay, these when they're a lot of them like you see here, this is when you take your data and you write it down on your pad, okay, and that way when price trades to these levels, okay, or approaches these levels, you'll have that in mind. So, okay, look, this is a reactionary level based on a daily time frame. So that way you don't have to have all these lines on your chart, okay? So what we're going to do is we're going to take our chart and we're going to drill down to a 4-hour basis, okay? And we're going to be just simply looking at the market from the standpoint of August 23rd. Okay, and what I did was I just moved the fixed chart position, and it's just a little difficult to see here, but I will show you all that when I talk about setting up templates for MT4 and how you can maneuver around. So we're going to do a 4-hour chart. Okay, and here we are. We're essentially with these same levels noted, we move down into a 4-hour basis. Okay, and what I'm just going to do is I'm going to scrub forward a little bit. Okay, and right about here is where we're talking about how the market was poised to trade lower. And I'll promise I'll get to the point of which we're going to explain why it was going to go lower. But for now, I just want to just illustrate how the market eventually traded with these levels. Okay, now these levels were based on key reaction levels on a daily time frame before the fact. So in other words, we're going to basically establish a point of which we'll delineate that with a vertical line here. We'll just say beginning here, we were expecting the market to go lower, and we're going to start watching and just going to study how price reacted to these levels going forward. Okay, and really what you're doing is you're looking at how price moved, reacted, traded down to and up to resistance and support, how price worked specific levels, broke down, found support at it, then broke lower and moved around and gyrated. Okay, now these levels are just simply established off of the daily time frame. Now when you move to a 4-hour, okay, like we learned in the previous 2 episodes, when you break your market down from a daily to a 4-hour, the 4-hour is going to have more dynamic support and resistance levels that were not as clearly discernible as were on the daily chart. Okay, so this level here, okay, you would have on your chart as well, and you can see the price reactions from there as well. And you have this swing low. One could have that on your chart as well. And you can see how price reacted around that as well. Okay, and now what we're going to do is we're going to move to a 15-minute basis, and we're going to look at last week's trading. Okay, this is last week trading the Euro USD. This is a 15-minute time frame. Now what we're going to do is we're going to put the vertical lines in, delineating the actual days. You have Monday's trading here, Tuesday's trading here, Wednesday, Thursday, and then Friday down here. Now we're calling the market lower, and you can see the market did in fact trade lower. We're going to be looking at how price reacted intra-week, okay, but we're going to talk about some things that haven't really been touched on if you've been following me for a while in great detail. Okay, so now what we're going to do is we're going to be discussing how the market itself. We're going to zoom out just one more tap just so you can get a feel for what has happened. The market traded lower up in these levels here where we were calling it lower, and broke down rather aggressively. Okay, so you can see much more dynamic view of how price had respected these support and resistance lines that we arrived at on a daily time frame. Okay, so now obviously we can see in hindsight that it caused the market to turn at resistance and support, and once support was broken, eventually traded back to it, found it as resistance. Okay, we understand those central tenets to the marketplace and how technical analysis is generally perceived and or viewed in a hindsight basis. Okay, but how do we use these levels going forward? Okay, well, number one, unless you have these types of price points, okay, or support and resistance levels on a higher time frame, there's absolutely zero reason to expect a trade to form. Okay, again, here's one of those notepad moments. Okay, write this down and underline it several times. You do not look for a trade or a trading pattern on your intraday charts unless it is trading at a higher time frame support resistance level, okay, or at a higher time frame reaction level. That means the trade has to be formulated and framed around a level that you had already arrived at from the daily and or 4-hour time frame. Okay, now here's a question for you, and you already know the answer to this, I'm sure. So again, I'm not trying to browbeat anyone, but I'm telling you, I've done the same stuff. So hopefully you'll learn from it like I did, and you'll stop the bleeding and you'll start moving towards consistency. So now looking at your own personal trading, how many times, daily, weekly, in the last few months or so, how many times have you looked at a 5-minute chart or a 1-minute chart, or maybe an hourly chart, looking for a pattern, a price pattern, and then trying to chase the market after you see it moving because you didn't have the confidence, the trust, the pattern, because there was nothing framing it on. Okay, you just saw a pattern or similarity of what would be considered a price pattern, and then reacted to it after the market started moving what you felt was a confidence booster in the favor that the favorable direction the pattern was suggesting it would move, and then all of a sudden saw the market turn on you. Even though that supposed price pattern was there, it eventually turned on you. Has that happened to you? I can tell you with great surety, if it hasn't, and if you don't do these types of things, it surely will. Price patterns by themselves, I'll speak harmonically. Gartley's, butterflies, bats, all those patterns, okay, that you hear banted about on the internet and or YouTube educational series or reviews or some quote-unquote previews, they may or may not be profitable. But if you don't have that pattern framed around a real reaction level, okay, and again, we've talked about why the market reacts like it does, and when you see market moves that are dynamic, okay, because it's the institutional sponsorship that takes the market up or down. Okay, retail traders are not going to do anything to this marketplace. We are participants that are hopefully like the fleas on the dog. Okay, we're on for the ride. Once in a while we get a bite. Okay, but if we don't watch it, the dog will scratch us right off. So we are hopefully positioning ourselves at a time and place, really, in terms of price, where the market is highly sensitive to market reactions on the higher level trading entities like the banks, large funds, institutions. If those traders are participating in the marketplace at that time frame, okay, at that time of day, at that date, okay, at that price level, you are in a much better position, technically speaking, as a trader than those that just simply go out and say, well, the market's been going up for the last 6 days, so it's probably going to keep going up, so let me just go in here and buy it today. Okay, because I can tell you, I know a lot of people that send me emails, and again, please, I'm only using this as an example, so don't let this be an impediment to you ever sending me emails or questions or comments or anything like that. But folks do these types of things, and here's another disclosure. I did that same stuff, guys. Okay, when I actually traded commodities, if the market was going screaming up, okay, and I would be watching it do it in the middle of the summertime during drought season, and if the wheat market was going straight up, it could be up for 19 days. And I'm like, wow, it's been going up, let me just get in there and buy that. Okay, and sometimes I was lucky, and then other times I was not, okay, because I was chasing the market. By having these levels predetermined based on the higher time frame, you can sit on your hands and exercise that dreaded word, patience. Okay, because a lot of times I talk about that, and I stress the importance of having patience and submitting to time, okay, because if we're using these daily and 4-hour charts, it's going to take time for price to get to these particular price levels. Now, why am I teaching this time frame? Well, because most of you can't sit in front of your computers all day long and trade for a living. As much as you aspire to do that, y'all have what? Responsibilities. You have mortgage payments, you have children, you have spouses to take care of. If you're wives, you have husbands to deal with. So the bottom line is you have a lot of responsibilities and very little time on your hands to be able to apply to analysis. Now, sure, you can go back and look at the hindsight and study intraday action like that, And there's certainly nothing wrong with that, but for the most part, by far and large, majority of you are watching this all have 9 to 5s or similar that keeps you from having the time to sit in front of the charts and trade intraday. So again, I'm teaching this time frame because it'll allow those to have jobs to formulate trading ideas in your demo account to build confidence and understanding in technical analysis, and still possibly take part of profitable swings that the market entities push price up or down based on these higher level support and resistance levels. Now, again, we have a snapshot in front of us here. This is essentially 2.5 weeks worth of price data. But again, these levels were noted prior to these price points up here. Okay, we were calling the market lower up in here, and the market has slid lower. Okay, to the tune of about, what is that? Let's get a good feel for what that price level is. We'll get about the middle of that consolidation. And the lowest low on last Friday comes in around 285 pips or so. Not bad for a future perspective in terms of analysis. A lot of my haters that really have no interest in learning this stuff. They just want to derail and detract folks that are out here doing this stuff for free. I don't sell nothing. I just do it as a hobby. As you guys can see, it's been a delay in my release of this episode, and that's another reason why I will never sell anything, because I really have a life, and I'm not going to subject you guys to any kind of payment, okay, and selling things, because number one, I don't want the hassle. Two, I don't need your money, and three, I can't promise you I'm going to have the free time to consistently give you what you would reasonably expect on a paid service. So there are guys out there that have
Okay, we're gonna hold it there. I do gotta start getting ready soon and eat, so catch you guys later or tomorrow.